Okay, so we now move on to another conversation from two mutual fund experts, Sailesh Raj Bhan, the Chief Investment Officer, Equity Investments at Nippon India Mutual Fund, and Amit Tripathi, the Chief Investment Officer, Fixed Income Investments at Nippon India Mutual Fund, are joining us. Well, both from the same group, so we want to get an idea of the equity-debt balance as well as favorite themes. Gentlemen, thank you very much for joining us. Well, let me start with Amit first, rather than Sailesh. Amit, do you think that you will be in a better position this year than the equity master? Are you likely to see a preference for debt from equity this year?
Good morning. Yeah, I think the carry part of the fixed income returns has definitely improved significantly, and that does give fixed income kind of a better ground to start with for the remaining part of the year. To that extent, I would say that in terms of allocation, yes, fixed income would be a reasonably larger part of allocation this year vis-a-vis what was the case in the last 2 years.
Sailesh, would you agree? Everyone we ask believe that even if Nifty, which is expected to, Nifty outperforms global indices, especially Wall Street indices, are seen declining this year. So will debt be more attractive in terms of gains than equity?
Clearly, for the last several years, it's been only equities as an asset class which really delivered. And I think now we have seen there is certainly a shift towards higher interest rates sustaining for some period of time, making alternatives like debt also attractive. So I think clearly the world has shifted, so the role of debt has clearly gone up significantly, and I think it should also become an important asset class as we get along from here.
Okay. On the equities front, Sailesh, what is the expectation now in terms of earnings? For the full year, what are you penciling in, and what are the spaces, the sectors where you see an outperformance on the earnings front?
The earnings clearly will have some kind of a struggle versus, say, what was anticipated 6-12 months back in terms of the kind of earning growth that would come because of multiple global factors like the US side or the export demand from Europe and even what's happening in China. Clearly, there will be an earnings struggle. Earlier expectations were trending in the range of 15-16% kind of compounding of earnings over the next 2 or 3 years. I think at least in the next 12 months, we are looking at early double digit, like 10-11% kind of earnings growth, which is a meaningful step down from what would have been the normal course post the recovery from COVID, and primarily driven by the global demand challenges which are there. Even in India, we have a very strong domestic demand recovery, but now as we enter the post-COVID phase, as we call it, could there be a slowdown in terms of the pent-up demand which came about because of COVID is a factor which we would want to watch out carefully for the next 2 or 3 quarters. From a sector point of view, interestingly, many sectors are now coming back to life, and we are back to the normal world where the traditional sectors are finding greater favor and finding greater expectations of earning revival. For us, it's the investment cycle, which I think the engineering and the manufacturing space, which clearly is best positioned from an earnings point of view. And there the earnings could be maybe 30-40% higher than what even index earnings can be over the next 12-18 months or even longer. Similarly, banking earnings should beat market earnings generally over the next 12 months as well, given the sweet spot they are in, the demand for credit, the ability to price, and the kind of very low NPAs in the cycle or virtually no large credit costs in the system. Other sectors which appear interesting more on a valuation point of view are, and the recovery in growth is pharmaceuticals, and there are certain ignored sectors like insurance. So these are broader 3 or 4 categories which we think will matter in the next 12-18 months for investors to do well.
Okay. Well, then let me get back to Amit. Amit, which category of debt funds would you recommend or would you believe will do well? Would you go more for credit opportunities, considering that there are such healthy balance sheets? Would credit opportunities be the sweetener?
Yeah, you're absolutely right, Lata. Possibly the healthiest balance sheet that we have seen for some time now. The issue, although, has been in terms of pricing in the credit space, and while that is getting corrected as we speak, I guess it will be another 6 to 9 months where you get the requisite spreads across board for the incremental risk that you are taking. So for us, it is more rate focused right now, and you tend to capture spreads in selective spaces where you're getting it right now, but don't try to overdo it, because across the board, the banking system pricing is still reasonably aggressive as compared to where the capital markets would want to be in terms of credit spreads, that is. Within rates, I guess we are in that phase where one would typically want to be in the intermediate duration part of the yield curve. From a product perspective, it would typically be products which would run a duration profile of around 2 to 3 years. The reason for that is simple. The reason is that as we are closer to the terminal rate, maybe we reach there in the next quarter or so, the focus will not only be on current carry. The curve is very flat, so carry across board is the same essentially. But the focus will not only be on current carry, but the focus will also be on preserving the current carry for some period of time, because while this year might be completely about carry, as we enter into the second half of this year into next year, at that time the preservation part might play some role as rates start to inch down. And in that sense, I think intermediate duration is space to be to capture both the current carry as well as preserve it to a reasonable extent.
Okay. Sailesh, just one follow-up question. You said that, earnings growth is going to disappoint from 15-16% projected earlier. It's now 10 to 11%. Which are the sectors that could drag the earnings down? You spoke about manufacturing and banking on the upside, but on the downside, where do you see the pressure?
See, we've got several sectors which have seen a bump up. Say, for example, metals had an extraordinary growth in profits in the last couple of years. So high base there will matter. And on an absolute basis, metals are a meaningfully large component of overall profitability of the indices. Even you have consumer companies might struggle a little bit still on earnings, at least for 1 or 2 quarters till the rural growth rebounds. So that is one more space where earnings can be a little muted. I think the disappointment, or I would say the lower earning trajectory, is more a function of sectors having greater global exposures. And even IT services falls into play, where you may have maybe single digit or thereabout earning growth in the next 12 months versus what initially was running early double digits or a little higher. So these are spaces which might be challenged, and primary pressure coming from global growth and secondary pressures coming from very sharp rebound in profitability in certain sectors like metals and maybe retail and some spaces which can normalize in the next 12 months.
Okay, all right, gentlemen. Thanks so much for stopping by and filling us in with your insights. Wishing you all the best for 2023. Well, moving on then, NCC, that's the next corporate on our radar. The construction major has bagged 5 orders, aggregating to around 3,600